So I want to take a few minutes to look at two of the theses that are being put forth on sort of investors and how they behave. Now, the first is that stock fund investors themselves herd stock and bond fund investors. Now, you can look at the historical data, which I'll show in a moment, and you can see that there's very little evidence, unless you view sort of a 1% movement in any given month as a share of assets in totality as herding. And if that's the definition of herding, then that seems to be a fairly low bar in my perspective, but we can have that discussion. The reason that you tend to have a great deal of stability is that, first of all, these retail investors are long-term investors. They're often coming through retirement. And so as a result, that money is staying there. What this chart shows is sort of a range of the outcome of flows that we're seeing on a monthly basis as a percentage of assets. The black line is the net impact in the industry, and this is for all bond funds in the United States going back to 1990. And it's flows, net flows as a percentage of assets. And as you can see, it's hovering around zero. Sort of in any given month, you're sort of slightly below zero, slightly above zero in terms of flows as a percentage of assets. Now, certainly individual funds can have large outflows in any given month. And this line here, the red line, shows the 10th percentile funds in any given month. For instance, in October of 2008, 10% of the funds had outflows of 8% or more. But 10% of the funds had inflows of 4% or more. And effectively, then, the net of those inflows and outflows was about 1.5%. That is, it's a relatively closed system. That money coming out of one fund is often immediately reinvested or very soon reinvested in another fund. The investors are wanting to maintain their market exposure. They're wanting to stay in their investment profile that they've set up. They're usually doing this through a 401k or with the help of an advisor. This money is not sort of racing sort of by trillions of dollars in large percentages into cash or something like that. It just doesn't happen in that stock and bond fund space. And the reason is because so much of this is for retail, focused on the long term, and market timing, as financial advisors and academics have argued for years, is just not a very effective way to invest for the long term. We tend to see that, for the most part, investors tend to be adhere to that. So the second thesis is perhaps there is something fundamentally different about funds, investing in a fund rather than investing directly in securities. And therefore, there may be a first mover advantage. Now, as I said, in a mutual fund, all the costs are shared. So if I sell my shares in the fund, I am paying a pro rata share of the cost that the fund incurs. But other investors in that fund, if there's trading costs involved in selling those securities, will also be paying a portion of that. And so there's some concern that potentially that could build up, or perhaps as the fund sells assets in a falling market, the price given today, if the fund has to sell an asset in 3 or 4 days, could potentially have an impact. Just a kind of as a compass here, if this were sort of a fundamental feature and something that that funds could not sort of counter, then we would see significant market lags on index funds. Index funds would have often then not track their indexes very well. So fund managers can actually use a number of tools such as bid pricing, redemption fees, offsetting redemptions with new sales, managing market exposure through derivatives, redemptions in kind, which is a standard for ETFs, but also can be used for mutual funds as well. And then finally, as I've indicated, selling by the investor is not risk-free. They pull out of the market and their market exposure goes away. And they could actually, by sort of anticipating trying to save a 0.5% on trading costs, of future trading costs, they could actually be out of the market and be out even more. And that long-term impact is important.